Joe Rogan runs the #1 podcast in the world. He's interviewed Elon Musk, Mark Zuckerberg, and Alex Jones. He's also outlasted the sort of major controversy that's ruined so many others. And Spotify paid him 9 figures to get exclusive rights to air his podcast. With more and more people listening to podcasts these days, it's no surprise to find Spotify to be the 3rd most searched music and podcast company on Trackstar amongst financial advisors over the last month. Shares are off their all-time highs by a stunning 77%, yet the company generates solid cash flow and has slowly started to turn a quarterly profit. So is it a good investment? Now, Spotify is a digital music and podcast platform. It boasts 80 million songs and more than 4 million podcast titles, attracting over 433 million users. And Spotify has more than doubled its revenues from 2017 to 2021, going from $4 billion to $9.6 billion. Right now, the company is on pace for its best year ever. Its 12-month trailing revenues of $10.7 billion generates cash flow of $380 million. Additionally, Spotify holds $3.5 billion in total cash and $1.7 billion in total debt. Its current ratio of 1.3x hints at nice liquidity should issues arise. Spotify may generate cash, but it's yet to turn an annual profit. IHRT finds itself in a similar situation, but other competitors are profitable, and only Sirius is as niche as Spotify or iHeartMedia. But at a price-to-sales ratio of 1.4x, Spotify is doing better than Apple, Amazon, and Sirius. But keep in mind, though, that Apple and Amazon have multiple sources of revenue outside of their music and podcast businesses. Spotify's gross margin of 25.7% is fairly low, aligning with its pay-for-talent strategy. When you look at iHeartMedia's 62.8% gross profit margin and Sirius's 50.5%, you have to think there's something wrong with Spotify. The company has grown faster than its competitors at 24.2% year over year. iHeartMedia is the closest at 16.6% revenue growth, while Apple's is 11.6%. However, Apple, iHeartMedia, and Sirius have better EBITDA growth numbers than Spotify because, well, they turn profits. In our opinion, this is a 5 out of 10 ranking stock. Spotify boasts a market cap of $16 billion and it hit $10.7 billion in sales the last 12 months. So does its stock price deserve to be where it is? Well, the company generates positive cash flow and has killer growth, but it doesn't generate accounting profits. It also faces intense competition and needs a major pipeline of great new talent to keep up the pace. Investors should value Spotify based on lower growth assumptions with positive cash flows that eventually turn into profits. The current $88 a share is still too rich for that much uncertainty. Fair value is likely somewhere between $50 and $75 based on cash flow.